Good evening, class. If you can hear me, just type in the chat so that we start. So we are starting. So the sound was not there because I was not talking, isn't it? Yes, so we are starting. If you can hear me, type in the chat so that we start. No one is hearing me, or if you can hear me, just type in the chat so that we begin. I'm getting no response. Am I audible? Yes, I think I've got some two saying yes. So we'll begin immediately. The one saying not clear, are the others saying the same thing, it's not clear or what? Okay, I think we will just begin immediately, isn't it? So last class, we were looking at preparing financial statements, isn't it? If you've seen the syllabus, so after preparation of financial statement, we go to analysis of financial statement, isn't it? So under analysis of financial statement, we have ratio analysis. We also cover common size financial statements. We also cover trend analysis of financial statement. We also cover cross-sectional analysis. And finally, we will finish with use of graphs and charts, isn't it? So in today's class, we will start with ratio analysis, isn't it? So as illustrated there on the screen, ratio analysis is a technique used to evaluate and interpret financial statement of a company, isn't it? So it involves calculating various ratios that provide insights to the company's health, performance, and efficiency of the organization, isn't it? So maybe under health here, we can have maybe the liquidity ratios, isn't it? Yes, under performance here, we can have ratios like the market ratio or the profitability ratios, isn't it? And also under efficiency, you can have the market ratios, isn't it? So these ratios are computed by comparing different financial statement items, such as the income statement and balance sheet figures, to assess the relationship between them, isn't it? So we'll start with the examples. So first we'll start with liquidity ratio. So in a layman's language, liquidity ratios assess the company's ability to meet its short-term obligation and measure its liquidity position, isn't it? You can see it is mainly focusing on short-term obligations, isn't it? Current liabilities and current assets, isn't it? So these ratios indicate the organization's ability to convert its current assets into cash and cover its current liabilities. So the first liquidity ratio that will come across is the current ratio. So the current ratio measures the company's ability to pay its short-term obligation using its current assets. So this one is short-term obligations, isn't it? Current liabilities. So how can our current assets cover our current liabilities, isn't it? So it is calculated by dividing current assets by current liabilities. And there you've been given the formula highlighted. The notes I sent earlier, I sent during the last class, isn't it? I sent the notes you have there. So the formula is current assets divided by current liabilities, isn't it? Then, so a higher current ratio is generally considered favorable, isn't it? As it indicates a better ability to meet its short-term obligations, isn't it? So, for example, let's say our current ratio, it is at 2, isn't it? So at 2, it means our current assets can pay our current liabilities twice, isn't it? If it is 3, it means our current assets can pay our current liabilities thrice. So that's why we are saying a higher current ratio is generally considered favorable, as it indicates a better ability to meet its short-term obligation. However, an excessively high current ratio may suggest inefficient use of assets, isn't it? It means, so again, and if you have a very high current ratio, it will mean that maybe our current our assets, isn't it? We are not using them, we are holding them. So that's why we again have an excessively high current ratio, isn't it? It means we are not using our current assets. Then I will go to the second one under liquidity ratios. That is the quick ratio, isn't it? So the quick ratio is a more stringent measure of liquidity as it excludes inventory from current assets. So quick ratio excludes inventory, isn't it? So the current assets will less inventory because you can say it focuses on assets that can be quickly converted into cash to meet its current liabilities, isn't it? So we exclude inventory. So the same thing, the quick ratio provides a more conservative assessment of liquidity, as inventory is often the least liquid current asset. A higher quick ratio suggests a strong ability to cover the short-term obligations without relying on inventory. So the quick ratio will exclude inventory, isn't it? So it's more conservative assessment of liquidity of the company, isn't it? The health of the company, in other terms. Then we look now for the last one there, which is the cash ratio. So cash ratio is a more conservative liquidity ratio as it considers only cash and cash equivalents in relation to current liabilities. It measures the company's immediate ability to pay off short-term obligations, isn't it? The same thing, these ones are concepts that you've already come across, isn't it? Here we're just repeating, then we go to the Excel file and see how it works out, isn't it? So we've been told the cash ratio only considers cash and cash equivalent over the current liabilities, isn't it? Then the same thing, a higher cash ratio indicates a strong ability to meet short-term obligations without relying on other assets, isn't it? So if it is higher, it will be better. If it's lower, it won't be better. Then I will go to part 2 of the ratios. We have the solvency ratios, isn't it? So solvency ratios are also known as the leverage ratios. These assess the company's long-term financial stability, isn't it? You can see now we're talking on long-term financial stability, isn't it? That is the non-current liabilities, maybe the debt, isn't it, and equity. These ratios measure the proportion of debt in the company's capital structure and evaluate its ability to generate sufficient earnings to cover interest payments and debt obligations. So the most common solvency ratios include the debt to equity ratio, isn't it? Under which debt to equity ratio, the debt to equity ratio compares the company total debt to its shareholders' equity. It indicates the proportion of financing provided by creditors versus shareholders, isn't it? You can see here now it is the debtors. The debtors who have provided the debt can be creditors versus the shareholders, isn't it? So debt to equity ratio is total debt over total equity. Then additional on that, it says a higher debt to equity ratio suggests a higher degree of leverage and financial risk, as the company relies more on borrowed funds. A lower ratio indicates a lower level of debt relative to shareholders' equity, isn't it? So the same thing, it is just total debt divided by equity, isn't it? So if you have a higher debt, isn't it, a higher debt to equity ratio, isn't it? Like for example, I use the example of 2 again. For example, let's say our debt to equity ratio is 2. It means our total equity falls in our debt twice, isn't it? So it means we rely more on borrowed funds, isn't it? So relying more on borrowed funds must be paid back, isn't it? Yes, the debt must be paid back. So it has a high degree of leverage and financial risk, isn't it? So a lower ratio indicates a lower level of debt relative to shareholders' equity. Then we'll go to the next one, which is the debt ratio, isn't it? So the debt ratio measures the proportion of the company's assets that are financed by debt. It indicates the percentage of the company's assets that are funded through liabilities, isn't it? So debt ratio will be the total debt over total assets, isn't it? Here it will be like total debt over total equity and liabilities. Another way to do it, because total assets is equals to total equity and liabilities, isn't it? So we say a higher debt ratio indicates a larger proportion of assets financed by debt, which indicate higher financial risk. A lower ratio suggests a smaller reliance on debt finance. The same thing. If the debt ratio is high, there is a higher financial risk, isn't it? But if it's low, it means that there is a small reliance on debt finance, isn't it? So you don't rely on debt a lot. Then another one that comes under solvency is the interest coverage ratio, which assesses the company's ability to meet its interest payments on outstanding debt. It measures the company earnings relative to its interest expense, isn't it? So company earnings, that will be earnings before interest and tax divided by interest expense. You'll find the coverage ratio. So a higher coverage ratio indicates a better ability to cover interest payments with earnings. It suggests a lower risk of defaulting on debt obligations. A lower ratio may indicate a higher risk of financial distress, isn't it? So this one just measures the ability to pay your interest, isn't it? So if it is high, it will mean that there's a lower risk of not paying your debt obligations. But if it is low, it means there's a higher risk of financial distress or discomfort, isn't it? So there will be some financial limitations, isn't it? Because your debt obligations are very low, isn't it? They are very high compared to your earnings. Then we'll move again to another one, debt service coverage ratio. So the debt service coverage ratio evaluates the company's ability to meet its long-term debt obligations, including both principal and interest payments, isn't it? So it measures the company's cash flow available for debt repayment. So the debt service ratio can be computed as earnings before interest, tax, and depreciation and amortization divided by total debt service. So the debt service here will be the principal amount plus interest payment, isn't it? The total one, isn't it? The total of it. Then a higher debt service coverage ratio indicates a greater capacity to service debts and suggests a lower risk of default. It demonstrates the company generates sufficient cash flow to cover its debt obligation, isn't it? So here under debt obligation, it will be principal. Remember the other one, the interest coverage ratio is just on the interest, isn't it? Here it will be so the principal plus interest payments, isn't it? And also it's the same thing to interest coverage ratio. Then I think we'll go to profitability ratios. So these ones are very common. I think you all know them, isn't it? So profitability ratios assesses the company's ability to generate profits and measure its overall profitability. These ratios help evaluate the company's operational efficiency, effectiveness in managing costs, and ability to generate returns to its shareholders. So the common examples will be the gross profit margin, isn't it? And the gross profit margin is just the gross profit over net sales times 100, isn't it? Then a higher gross profit margin indicates better efficiency in managing production cost and pricing strategies, isn't it? So remember, from net sales, we always go to cost of sales, the gross profit, isn't it? So if our gross profit is high, it means we are managing our production cost, isn't it? Our cost of sale, we are managing them, and we are having good pricing strategies, isn't it? We'll move to the next one. So the next one is very similar to that. It is the net profit margin. So the net profit margin represents the percentage of revenue remaining after deducting all expenses, including tax, isn't it? It measures the overall profitability of the company, the net income divided by net sales, isn't it? So a higher net profit margin indicates better or overall profitability and effective cost management. Then we'll talk of return on assets. Let me check the chart. So I said the debt service will be the debt to the principal amount plus the interest, isn't it? Here it is. The debt service ratio, so total debt service will be both the principal and interest payments, isn't it? So I think we'll continue. So we are here. So we are saying return on assets, isn't it? So return on asset measures the company ability to generate profit from its asset, to evaluate the efficiency of an asset, utilizing its utilization in generating earnings, isn't it? So return on assets is just net income over average total assets. So a higher return on asset will be favorable because it suggests better utilization of assets to produce or to generate profits, isn't it? So a higher return on asset or ROA will be favorable. Then we have also return on equity. So return on equity assesses the company's ability to generate returns from its shareholders. It indicates how effectively the company utilizes shareholder equity to generate profit. So this is the utilization of shareholders' investment or shareholders' equity. It will be net income divided by average total equity. A higher return on equity indicates better profitability in relation to shareholders' investment, isn't it? In relation to shareholders' investment. Then we have operating profit margin. So this one will be just operating income divided by net sales, you multiply by 100. And a higher one is recommended, isn't it? Then lastly, on that, we will have the return on capital employed, isn't it? It's also a profitability ratio that measures the return generated by the company's capital investment. It assesses how efficiently a company utilizes its capital to generate profits. Here is the calculation. So it will be earnings before interest and tax. You divide by total assets, you less current liabilities, isn't it? So additional points on return on capital employed. ROCE takes into account the operating profitability of the company by considering earnings before interest and tax, which excludes interest and tax, isn't it? The denominator, which is total asset minus current liability, represents the capital employed, isn't it? Remember, current liabilities, we have not paid them, isn't it? So this one will represent the capital employed in the business. So the current liability comes from the business. We have not invested in them, but other non-current liabilities, e.g. loan, we could have borrowed a loan. So that one is a capital employed in a business, the shareholders' funds, isn't it? So what we list is just current liabilities. Example of current liability are like the trade payables, isn't it? So that one is not an investment in business, isn't it? So a higher return on capital employed indicates the company is effectively utilizing its capital to generate profit. It's often considered a more comprehensive measure of profitability as it considers both operating earnings and capital invested in the business. Then I think we'll go to market ratios or efficiency ratios first. So under efficiency ratios are also known as activity ratios. They measure how efficiently a company utilizes its assets and resources to generate sales and manage its operations. These ratios provide insights to the company's operational efficiency and effectiveness in managing its assets. Here are common examples. So inventory turnover measures how quickly a company sells its inventory and replenishes it. It indicates the efficiency of inventory management. So inventory turnover will be the cost of goods sold divided by average inventory. Here you mark average inventory. A higher inventory turnover ratio suggests efficient inventory management and quicker sales. So if the inventory turnover is high, it means our inventory is always sold quicker sales, isn't it? We sell high, we say like fast, isn't it? We sell fast, isn't it? So we sell high our inventory, so to have a high inventory turnover. Then we have the account receivables turnover, measures the efficiency of the company in collecting payments from customers, isn't it? So that one would be the credit sales, net credit sales divided by average receivables. A higher account receivable turnover ratio indicates efficient credit management and timely collection of debts, isn't it? Then we have the assets turnover ratio. So here I'm just a little bit faster because the notes I sent them and I requested you to pass through them. And also, it is something you've already covered, isn't it? It's not a new concept. So asset turnover ratio. The asset turnover ratio measures how efficiently a company utilizes its total assets to generate sales. Asset turnover ratio will be the net sales divided by average total assets. A higher one will indicate better utilization of assets to generate sales, isn't it? We'll go to the next one, the fixed asset turnover. So it's the same to asset turnover, but now it will be over average fixed assets, isn't it? Only fixed assets or the non-current assets, isn't it? So a higher fixed asset turnover ratio suggests efficient utilization of fixed assets in generating sales. Then we have the payables turnover ratio. The payable turnover ratio measures the efficiency of the company in managing its payments to suppliers. So it will be purchases over average account receivables, isn't it? A higher payable turnover ratio indicates effective management of accounts payable and timely payments to suppliers, isn't it? And remember also under this, we also have other ratios, e.g. the account receivable days, account payable days, inventory days, isn't it? We also must consider that. Then we go to market ratios, so also known as valuation ratios. They provide insights into how the market values the company's stock and assesses its investment attractiveness. These ratios compare the company's stock price with its financial performance or market value. Here are some common. So price to earning ratio, the PE ratio. So it is the market price per share divided by the earning price per share, isn't it? Then we also have the earnings per share, the dividend yield. So we talked of price earning ratio, reflects the market expectations from the company's future earnings and indicate whether the stock is overvalued or undervalued. Isn't it? Then we have price to sales ratio. It will be the market price per share over net sales per share, isn't it? Then this one is useful when a company has negative or volatile earnings. It indicates the market's willingness to pay for each unit of sales generated by the company. So here it's when it's negative operations or the volatile, you are going up, going down, isn't it? We measure with the price ratio. Then we have price. The price to book compares the company's stock price to its book value per share, isn't it? So the book value is where you see ordinary shares, e.g. 10 per shilling, isn't it? The par value. Then we have earnings per share, net income divided by number of common shares outstanding, isn't it? Earnings per share is very common. So, and that is in the end of the introduction to ratio analysis. So maybe I'll just, let me share the new file, the Excel one. Just a minute, I share the file. Isn't it? If you are seeing the Excel file displayed, just type in the chat so that we know. If you are seeing the Excel being displayed, not the PowerPoint presentation. If you are seeing Excel being displayed, okay, so here is an example of it. And remember, this ratio analysis here, we've covered just the general of it, isn't it? In the examination, maybe you'll find it combined with something, isn't it? Maybe it is combined with the forecasting, isn't it? Maybe there are 2 marks they're saying, determine the following ratios, isn't it? You may ask the gross profit margin or what, isn't it? So that's how it comes. So it comes combined with another question, but here for learning purposes, we'll just go through them all, isn't it? This one comes maybe combined with another question because they will not ask you everything here. Maybe it will be just a few of them, isn't it? So you've been provided with the following statements from Babadogo Limited for the period between 2015 and 2018. So there you have the market price per share. You also have the number of shares, isn't it? Then you have the statement of financial position there. Then you also have the income statement, isn't it, for the years. Then we've been told required perform the following ratio analysis on the provided statements of Babadogo Limited and comment on your results, isn't it? So we'll start with cash ratio. Obviously, I told you this one. It will be equals the current assets, isn't it? So you just the current assets in your statement, you divide by current liabilities. As you can see, so total current liabilities here, isn't it? Enter without margin, isn't it? Maybe I'll widen here. Also the other one, also the other one, also the other one. Isn't it? And I do it at 2 decimal places, isn't it? So then I will go to quick ratio equal. So quick ratio is exclusive of inventory, isn't it? So I open your bracket. So I'll take all the current minus the inventories. Then you close your bracket. You divide by current liabilities, isn't it? That way, it's just a simple concept as that. Then equal cash ratio, so it will be cash and cash equivalent. So you can see here we had cash and marketable securities, and this one is our other. So we only have that one. So this one divide by current liabilities, isn't it? Then I select the data, then I do at 2 decimal places, isn't it? So here I just select this way and I drag, isn't it? I do Alt HBT, isn't it? And just from the comment, we will see that our current ratio is increasing, isn't it? It started at 1.8, it went to 1.6, 1.5, 2 to 3. So and the same to cash ratio, isn't it? So remember we said liquidity ratios measures the ability to pay short-term liabilities, isn't it? So it means here, because they're increasing, it will mean that our company is performing well, isn't it? Because they're increasing, isn't it? So there's nothing that will bring on doubt. Maybe here in 2015, it's because the company maybe was starting, but it is performing well as they go by, isn't it? So these ones are very simple concepts. That's why I told you this one will come in another question like just maybe you've been given a forecast. maybe we are given a forecast statement, you'll be asked maybe the gross profit or the sales growth rate, isn't it? So I'll repeat here, Control Z. Sorry for that, I was going. So what I was saying, equal, the current ratio is current, I'll repeat for the sake of that one, current assets, we divide by current liabilities, isn't it? Then the quick ratio, you start with opening your brackets, you take your total current assets, you less inventories, isn't it? Quick ratio, you divide by current liabilities, isn't it? Then for the cash ratio, it will be our cash and marketable securities divided by the current liabilities, isn't it? And here you don't have to do the rest. You just drag and the formula will go by, isn't it? As simple as that. Alt HBT to enclose them, isn't it? And the explanation or the comment was the liquidity ratios are increasing, isn't it? It means the company is can pay off, isn't it? Like from 2018, it means our current assets, isn't it? We can use our current assets to pay our current liabilities 3 times, isn't it? And here it means we can use our current assets, excluding inventory, to pay our current liabilities 2 times. And here now, our cash ratio can only pay our current liabilities at 0.2%, isn't it? Or 0.26, that is 26%. So our cash ratio can only pay 26% of our current liabilities. So if maybe our current ratio was very below, like if our current ratio could be like 0.6, it means we would be trading badly. If our current ratio is above 1, it's recommended, because you see, like it means our current assets can pay our current liabilities, isn't it? As simple as that. So the comment here, it will be the liquidity, the company is in a good liquid position, isn't it? The position is good. Then we'll talk of the solvency ratios, isn't it? This is just what we've covered. So debt equity equal sign. So debt equity will be the total debt, isn't it? Divided by total equity. So we'll take the long-term debt here, divide by total equity, isn't it? Total shareholders equity, that way, isn't it? Then we go next. So the debt ratio, isn't it? So debt ratio will be total debt. So here's the difference, the total debt divided by total equity and liabilities or total assets, isn't it? The same thing here. Then now for interest coverage ratio, isn't it? For interest coverage ratio, remember we are using earnings before. So we are using earnings before interest and tax, isn't it? So we must go to the income statement. So and here you can just see we have earnings before interest and tax, isn't it? So, but remember we also have here interest income, isn't it? And interest income is an earning before interest and tax. So we will add it back again. So equal, I'll take this one here presented. I'll add the interest tax expense, isn't it? Then I do it in brackets first. Sorry for that. Then all this amount divided by the interest expense, isn't it? So it means our earnings before interest and tax can pay our interest 16 times, isn't it? It means you are good. It means you cannot default on paying the interest, isn't it? Then you have the debt service ratio. So let me check. So we have depreciation. And yes, so the debt service ratio, I told you. Let me bring in the file. The debt service ratio, as you can see here, the debt service coverage ratio equals to the earnings before interest, tax, depreciation, and amortization over total debt service. And I told you debt service is the principal plus interest, isn't it? So for our case, we'll take our earnings before interest and tax. We also add the interest income, then we add back depreciation, divide by interest expense plus total debt, isn't it? So let me bring in the Excel file. So here it will be equal. So we take our earnings, so from the income statement, so this one. So maybe we can start with brackets because something wrong. So this one, isn't it? We remember we must add, we'll add the interest income, then we'll add also depreciation. Isn't it? The depreciation here. We'll add because the depreciation is in positive format, it will just go in as it is, isn't it? You divide by our interest expense, isn't it? So I'll open my bracket, our interest expense plus our debt, isn't it? So of which our debt is the 173 here, isn't it? For that year. I close the brackets, control enter. Remember here I'm not locking anything. I'm just doing it as it is, isn't it? I'll put 2 decimal places, then I drag. Isn't it? Then now you come to the comment, isn't it? As you can see, our debt to equity ratio is reducing, isn't it? At HBT. Our debt to equity ratio is reducing. It means the company is borrowing more, isn't it? Company is relying mainly on debt, isn't it? Because it was from 0.32, now it is at 0.14. The same thing will apply to the debt ratio because now the debt ratio is over total assets. Again, you can see that it is reducing, isn't it? And the interest coverage ratio, you can see that in the year 2016, it was like 25% more than this one, and it reduced to 20 and 18, isn't it? So a higher interest coverage ratio shows the ability to pay our interest, isn't it? This range is good, isn't it? So it means from the year 2016, we could pay our interest using our earnings. We could pay our interest 25, 26 times, isn't it? Then the debt service ratio, isn't it? Also, you can see the ability to pay our debt plus interest, isn't it? So the ability to pay our debt plus interest, you can see that it was down, it came up, then it went down, then it came up again, isn't it? So for the comment here, we will first confirm our debt, isn't it? So the position is good because you can see that our debt here, where is it? Our debt here, it means in this year we repaid and then we borrowed another debt, then we repaid some, isn't it? So for that one, it's okay going up, down, isn't it? Then let me check the chart. Yes, the depreciation was factored in, isn't it? The depreciation was factored in, but it was less, isn't it? You can see here, so C47, it's the gross profit, isn't it? You minus selling, general and administrative expense, then you less depreciation, then you less other expenses, isn't it? And these other expenses were in negative form, so I don't know why. Or it was more of an income, then I'll press escape, isn't it? But that the main thing is the concept. So here depreciation had already been removed when we arrived at our earnings before interest and tax, isn't it? But now for the interest coverage ratio, we are using earnings before. Let me just take you to the file so that it was on the debt service ratio, isn't it? So it was interest before earnings before interest and tax, isn't it? We are here, then we added back depreciation. That's why we are adding depreciation divided by debt service. So, okay, okay, let me take you back to the Excel. So someone is saying that I should type in the comments. I think it will take a lot of time, but because I'll send the file over, sorry, isn't it? So what we are saying, current ratio here, let me go insert comment. Isn't it? Current ratio will be current assets divided by current liabilities. Isn't it? I think the current ratio and this one, you know them. I think they're inserting comment. So debt equity ratio, debt over equity. Isn't it? Interest here. So I'll insert the comment here. So the comment here will be earnings before interest and tax divided by interest expense. Isn't it? And then this one, the one that is confusing a lot. So it will be earnings before interest, tax, depreciation and amortization divided by debt service, isn't it? So the debt service I told you is the principal plus interest expense. I'll change here the principal to be loan amount so that it's easily understood loan. Isn't it? It's just that way. This is a very simple thing. I don't know why it's disturbing. Please repeat. You see, the explanation is better you just understand it generally, isn't it? The explanation we were saying, a higher one indicates, but here no, it is not the higher one because it's more of, this topic is just more of introduction to forecasting, isn't it? So before we do forecasting, you must know the ratio analysis. Also, you know the common size. Before we go to forecasting, the way the syllabus is arranged is very important. So like here, a higher one means we can pay our debt, isn't it? And it had been written here, so I'll not repeat writing here because it will take a lot of time. You can see like here, a higher debt service ratio. I think I'm on the right one, isn't it? A higher debt service ratio, coverage ratio indicates a greater capacity to service debt and suggests a lower risk of default, isn't it? It demonstrates that the company generates sufficient cash flow to cover its debt obligations, isn't it? So, and the rest, so this one comes from the income statement, isn't it? So the gross profit margin, you know it, so it is the gross profit. divided by the sales, isn't it? Net profit margin, the same thing, net profit or profit after tax or net income divided by the sales, isn't it? The very simple ones, isn't it? You press enter. Then now we have return on assets, isn't it? So return on asset has the average part, isn't it? So return on asset cannot start on the first year because it takes the average, isn't it? The average of the two. So it will start in 2016. So return on assets, isn't it? So the net income in 2016 divided by average total assets, isn't it? So you'll open your bracket, two brackets, isn't it? Because you want to find the average total assets. So you come to total assets here, isn't it? So you take the assets of 2015 because you are looking for the average plus the current, you close the first bracket, divide by 2, you close the second bracket, isn't it? Then enter. I'll give at 2 decimal places, also these ones are 2 decimal places, isn't it? And then return on equity, it's over average equity, isn't it? The same thing here, it will start in 2016 because of the average. So the income statement was down, so the net income, isn't it? Divide by average. So you open your two brackets there. So the equity in the previous year plus the current, you close your bracket, divide by 2, then you close the second bracket, isn't it? Enter then at 2 decimal places, isn't it? Then we have return on capital employed. So under capital employed is where we less current liabilities, isn't it? From the total assets. So remember, here we don't have the average. It means we can do from 2015. So this is the return divided by the capital employed, isn't it? You open your brackets. So the capital employed will be your total asset minus current liabilities, isn't it? Then control enter. Then the last one is net profit margin, of which this one will just come from here, isn't it? So I think we do this one, then we do common size. The other two, let's just finish first. So operating profit margin, isn't it? It is the EBIT, isn't it? Operating profit margin after you just without these ones, isn't it? Divide by the sales, isn't it? This one is just the common one, so I'll give it 2 decimal places. Then here, what I'll do, I'll just drag for the other years, provided I've done the first year. Then I can remove the borders with Alt-HBN, then Alt-HBT, isn't it? So just look also for a gross profit margin, isn't it? Our gross profit margin has been increasing. It means we are doing effective cost management, isn't it? Same thing to our net profit margin. We are managing also our expenses, we are managing them good because they are increasing, isn't it? Return on assets, it is reducing. It means we are not utilizing our assets properly, isn't it? We're not utilizing our assets properly to generate income because it's return on assets. Then return on equity, also it is reducing. The same thing, the equity employed, we are not fully utilizing it, but the percentages are in a good range. Then we also have return on capital employed. This is the capital that has been put in the business. So we had an increase here because I told you Also, non-current liabilities are under the capital employed, isn't it? And our loan, we acquired some loan, isn't it? You acquired some loan. That's why we have the up and down. Then you have the operating profit margin, of which is the same thing to gross profit margin and net profit margin. It is increasing effective utilization of our costs, isn't it? So what I was saying, because this one is more, they are more of the same thing. So maybe I will leave one for the assignment. I told you these are examined. Maybe they will examine just maybe 2 or 3, and they have been combined with another question, isn't it? Most commonly, the ratio analysis, they give the key performance indicators, isn't it? Of which key performance indicators? Of which key performance indicators are used in preparing dashboards, isn't it? So we are here on return on capital employed, isn't it? Equal sign. We'll take our return, our net income, it was 196. Divide by, you open your brackets, isn't it? So our capital employed will be our total assets minus current liabilities, isn't it? Then you close your brackets, control enter, control backspace, control backspace. So it has already gone to home. So here it is, then you just drag, isn't it? The capital employed, Alt HBN. So I just remove the borders there. Then I can put it in a T, a good border that way, isn't it? So we go to inventory turnover, isn't it? These ones are things you learned in the previous section. I didn't know it would take us a lot of time. Then so inventory turnover. Remember inventory turnover, the calculation is the purchases or cost of goods sold over average inventory, isn't it? Let me just open the file. It is the cost of goods sold. So here it is, isn't it? Yes, because of the average, isn't it? The average, you take the average. Also for inventories, this will come in, isn't it? Inventory turnover ratio, cost of goods sold divided by average inventory, isn't it? So here equal the cost of sale. So remember, we'll skip the first one. It will not start in 2015 because of the average, isn't it? When the previous and the, so the cost of sale in 2016 divide by, you open your bracket, you open your 2 brackets, isn't it? So average inventory. So you'll take the inventory of 2015 plus the inventory of 2016. You close the first bracket, divide by 2, then you close the second bracket. Isn't it? You can see that it is 5 there. Isn't it? Then we go to receivable turnover. Isn't it? It will be the sales. Isn't it? So here assuming that all our sales were on credit, isn't it? So it is credit sales divided by average. So you open 2 brackets, average account receivables, isn't it? So this one plus the second one, you close the first bracket, you divide by 2, then you close the second bracket, isn't it? Control enter, control backspace. Then you do at 2 decimal places, isn't it? Just the same thing. You go to assets turnover, isn't it? Net sales over average total assets equal So our sales in 2016 divided by, we open your two brackets. Our total assets will be this one plus this one here, divide by 2, then we close the second bracket, isn't it? So you can see that our asset turnover is very low compared to the rest. Then fixed assets, the same thing over. So our annex divide by, then you open your two brackets over only non-current assets, isn't it? So this one plus this one, you close your bracket, divide by 2, close the second bracket, isn't it? Then the payables turnover. Payable is purchases over average accounts payable, but in our question we don't have purchases, so we can use cost of sale, isn't it? Divide by, you open your two brackets, the purchases, the account payable, I mean, here are they. So the first plus the second, close your bracket, divide by 2, close the second bracket, control enter, control backspace. Isn't it? The two, I'll give them at 2 decimal places. Then we just drag. Isn't it? I will bring in the comments. Inventory turnover. Isn't it? Our inventory turnover is reducing. Isn't it? It means the company is holding on inventories, isn't it? Or our inventory are not being sold, isn't it? Inventory not being sold, isn't it? Because it's reducing. And we said a higher one is the favorable, while a lower is. Then you can see the receivables turnover, isn't it? Our debt collection, isn't it? It means debtors are not paying because it's reducing. Isn't it? Because you can see it was from 14, which was good. Now it's reducing. It means debtors are holding more on our money, isn't it? But I don't understand this question. On average inventory, why are we doing the average for the 4 years under review? Why are we not doing for 2015? I told you because of the average, you need the previous value. So here we will not have the average because the average of it will be for 2014 plus 2015. Even our asset turnover is reducing. Our fixed asset turnover also is reducing, isn't it? It means maybe we are like, for example, our assets are depreciating, isn't it? They are reducing. Our asset actually should be reducing, isn't it? The turnover should increase. It means we are not fully utilizing the assets, isn't it? As you can see here. So assets turnover, higher asset turnover indicates better utilization of assets in to generate sales, isn't it? It is over average total assets, and also this one is over average account receivables. Then I think those is what just to say. Then we have our payables turnover, isn't it? It means we are paying our suppliers on time, isn't it? So generally, you can see that our efficiency ratio shows that our company is not really efficient as it is going, isn't it? Because you can see for payables, they are increasing, isn't it? Here it reduced a little bit, but it was from 6.58. So it means like we are paying as we are paying our suppliers on time, isn't it? This one at least will be more, so that we hold on more. But it has increased. But like for example, it needs to be down, not more. It needs to be down so that we don't, like, we hold more on cash, isn't it? Like generally, this one is just from a business perspective, isn't it? You'll not want your debtors to take a lot of time to pay you, while you will want to take a lot of time to pay your suppliers. But here you see you're paying our suppliers really on time, isn't it? So the efficiency ratio for the company is not fully utilizing the market, isn't it? RHBT. So the common there will be the company is not fully utilizing the market. Then we have a price earning ratio, isn't it? Market price per share over earnings per share, isn't it? So the market price, I think we are given here. So we are given the market price per share, and we've been given the number of shares, isn't it? So we can find the earnings per share, isn't it? From here, from our earnings, we can find earnings per share, isn't it? So our market price per share have already been given. So you just take it, the 15, divide by, remember this value, number of shares you've been given in millions, isn't it? 10M, 10M, and this one has been presented in millions. Divide by, you open your bracket, isn't it? Now, to find your earnings per share, it will be the net income divided by number of shares, of which you are told it is 10, isn't it? Then we have price to sales ratio, isn't it? Maybe I'll confirm that one from the chart. Yes, this one I sent the other day. I sent the other day, isn't it? So so we are talking of the price to sales ratio, isn't it? It will be the market price per share divided by net sales per share, isn't it? Just dividing the sales by, so the market price per share divided by, so you open a bracket, the sales divided by 10, isn't it? The sales divided by that way. I'll show you that one. Okay, I'll reshare the file. Then here you cannot do the price to book value because there's the book value information. We are missing it, isn't it? We are missing the book value information. But we've been given the number of shares, isn't it? So the book value will be the share capital divided by the number of shares, isn't it? We've been given the book value, so price should be then just market price divided by, so we open two brackets. So the paid up capital divided by 10, isn't it? Because the values are, so I'm being reminded to close the second bracket. I just close. Yeah, even I just wanted one bracket there. Then you have the dividend yield, isn't it? So dividend yield is the dividend per share divided by market price, isn't it? So equal, so dividend per share. So to find dividend per share, it is the dividends paid divided by the number of shares, isn't it? A very simple concept. So there were 10 million, then you do divide by market price per share, isn't it? The 15 there. Then earnings per share, of course. So earnings per share will be the net income divided by the 10, isn't it? I'll do at 2 decimal places, then I just drag. I do Alt H BT, isn't it? As so you can see here, isn't it? This thing is just, if you know the formula, you've already known it, isn't it? It's the amount of division, isn't it? So any question, or can we proceed? Or do we do another ratio analysis? Actually, I want your comments, isn't it? Do you do another ratio analysis example, and I leave one as assignment? Isn't it? Then we do one, then we leave one as assignment, isn't it? Or we proceed to, I had not finished, or we proceed to common size financial statement, because this one is a very simple concept. Also, we are going with the time factor, isn't it? So you tell me as I start. So sorry, this one was just copied. So it was from, this one will present for 1 year alone, isn't it? 2013. So this one was copied from the last example. So what I'll do, I'll take this way. Sorry, first I'll take this way, all of it. Sorry about the years. So the years is what I want to correct. I'll unmerge first. Then I'll do this way, isn't it? I'll delete, then I'll do Alt H the end, isn't it? So here it is 2013. Control Enter, Control C, Control V, Control V, Control V. Because this is just 1 year, isn't it? Control V. So here will not be going forward, isn't it? So the current ratio equal current liabilities, current assets, I mean. So I think this is the total of current assets divided by current liabilities, isn't it? This is the total of current liabilities. As simple as that, equal quick ratio, current liabilities. So you open your brackets. So this one will be fast a little bit. So current liabilities minus inventory, isn't it? Divided by current liabilities. Isn't it cash ratio? Cash and cash equivalent, we only have cash divided by current liabilities, isn't it? Then the two I'll do this way, the 3 I mean. I do Alt H BT to enclose them, isn't it? So this one, I told you it was really just copied. But I've told you, like for exam purposes, it won't come like, yes, this one is more of just knowing the formulas, isn't it? When we reach on forecast, you'll see the importance of actually passing through the ratio analysis here. Because actually, you can be told maybe a certain ratio was the one that will be used in the forecast, isn't it? Maybe it can be the average of the three ratios is the one that we've used in the forecast. Then debt to equity, isn't it? So remember, ventures is also like debt, isn't it? So you open a bracket, this plus the loan, you close your bracket, divide by total equity, isn't it? So yeah, total equity will be this one because it was more of a group, isn't it? Debt ratio, so the debt, I'll open the bracket, so it will be the debentures plus the there, divided by total assets, isn't it? Simple as that. Then equal, maybe let me check the chart. See, I cannot resend now actually. So interest coverage ratio, isn't it? Earnings before interest and tax, isn't it? So here, remember here, we have our finance cost here, isn't it? So you open a bracket, so you take this one here, minus the finance cost to add it back, isn't it? Divide by the interest. So I start with a negative because it's in negative form, then I take on the finance cost, isn't it? So remember here, we don't have, we have not been given depreciation, isn't it? So again, you open a bracket, isn't it? So it will be more of the same thing. This one, you are minusing because the finance cost is negative. So it was earnings before interest, tax, depreciation, and amortization, isn't it? And we are not been given any information on depreciation, isn't it? So divide by, so you divide, so you open your brackets, we start with a negative, we take the finance cost so that it becomes positive, isn't it? Plus our debt, isn't it? And remember our debt, there are two, we have the debentures plus the loan, isn't it? You close your brackets, control, enter. So actually it depends how the question will come, isn't it? That way. Just, it's a very simple thing. So let's finish here. I think the time is enough. We can start on common size financial statement. Then I'll be sending the files to common size financial statement. So let me just send the files now to common size financial statement, isn't it? So as we proceed, when I'm looking for the files, so here, gross profit margin is just the gross profit divided by the sales, isn't it? Times 100, isn't it? So you can do times 100 or just do percentage there, isn't it? You add two decimal places. Then the net profit margin will be the profit for the period, isn't it? So equal the 1240 divided by the sales, isn't it? Of which the sales are this one here. Then times 100, isn't it? Percentage, two decimal places. Then return on assets, isn't it? Equal what we got. Just a minute, I'm locating the file again also. Okay, I think I've sent the Excel spreadsheet on common size financial statement. You can just check on WhatsApp, isn't it? I'll be sending the theoretical notes later. Let's continue here. So the return we got, isn't it? Divide by average total assets, isn't it? That's why we were given 2012, isn't it? So you open your brackets, the average, so you open two brackets, the average will be this one plus this one here, divide by 2, then you close the bracket, isn't it? Control enter. We'll go at two decimal places. Maybe we add one to see where exactly it is. Then return on equity, the same thing. This one, divide by, you open your two brackets, your equity. So it was this one here, plus this one. Then you close the first bracket, divide by 2, you close the second bracket, isn't it? Return on capital employed, isn't it? The same thing, the return, divide by, you open your bracket, only one bracket, your total assets minus current liabilities, isn't it? Control enter. Then operating profit margin. So we had this just comes exactly after excluding finance cost, isn't it? Excluding finance cost. So it's like we will take the gross profit. So we start with brackets if it has an adjustment shift. So the gross profit, so plus, I'm lessing operating expenses now to find the operating margin, isn't it? So I'm lessing because it is in bracket, it means it's a negative, isn't it? Divide by our sales, isn't it? I think you have received the file on common size financial statements as we continue. Isn't it? Inventory turnover equal the cost of goods sold. So because it's a negative, I start with a negative, I check there, divide by average inventory, isn't it? I open my bracket, my two brackets. So the first inventory plus the second one, isn't it? Divide by 2, then I close the second bracket. Then we go to receivables and over, it will be the sales. Divide by, I open two brackets, the receivables in the first year plus the second year. I close the bracket, divide by 2, I close the other bracket, enter. Isn't it? Assets turnover, the same thing. The sales over, I open my bracket, so the total assets, this one, plus this one. Isn't it? I close the first, divide by 2, I close the second bracket, isn't it? Yes, I think everyone has got the file. Okay, let me just check the drive. All right, we continue. Fixed assets, only the fixed assets, isn't it equal? So where are fixed assets? So in first is the revenue, divide by, you open your two brackets, only fixed asset or non-current assets, isn't it? Plus this one, divide by 2, you close the second bracket, enter. Isn't it? Then payables, you will use cost of sale because you have not been given the purchases, isn't it? But if you've given the purchases, you use the purchases, isn't it? So you open your two brackets. So our payables 1 plus the second one, you close your bracket, divide by 2, you close the second bracket, isn't it? Then I think you go to market ratios, isn't it? Price earning ratio, it says the market price per share over earnings per share, isn't it? So in our question, we are not given the market price per share, isn't it? We are not given the market price per share. This one, in this question, we tried to incorporate everything, isn't it? Price also, it's market price per share. This one is also market price per share. Then you have dividend yield, isn't it? It is the DPS over market price per share also, isn't it? And we don't have the market price per share. Maybe we can calculate only earnings per share, isn't it? So for 2013 earnings per share, isn't it? So you take the earnings you got, divide by, remember, so you'll open your bracket, isn't it? Remember the share capital was shillings 10 each, isn't it? So it means the number of shares will be this one, divided by the 10. Isn't it? You close the bracket, enter. So it is as simple as that. Then I'll put 2 decimal places. Also for here, 2 decimal places. Isn't it? Would you expound on the issue of double or single bracket, as in when you are supposed to use them or not? Okay, like this one is just like, you remember common board mass, isn't it? The two brackets comes from board mass, isn't it? Brackets first, isn't it? So for example, maybe this one, like this one here. So we are saying the average, isn't it? So if I open the two brackets, the first bracket and the second bracket, so the first bracket is to incorporate the addition, isn't it? The two, isn't it? Then I close the bracket. So that bracket first, isn't it? So Excel will add these two first, then before multiplying, then before dividing with 10, isn't it? Because this one is in bracket. It means this one is like one value, isn't it? So Excel will first add these two, then divide by 2, then what it gets, it will divide by this one, isn't it? I'll press escape. The point home. So it is board mass. It depends with just board mass, isn't it? Or like, let me just use another example here, isn't it? You have 1,000, you have also 2,000, or isn't it? That way. Then you have 2, isn't it? Then maybe you have another value of, let's say, 3,000, isn't it? And now you want to divide. You want to find the sum here, like equal. You want to find the sum first, isn't it? The 2. Then you divide this sum by 2, isn't it? So equal this one, divide by 2, isn't it? Then you divide now to the rest, the big one now, isn't it? So instead of going the whole thing, isn't it? You do this way, equal sign, isn't it? You take the first value that you'll be dividing, divide, you open two brackets, you take this one plus this one, isn't it? You close the first bracket, divide by 2, you close the second bracket, isn't it? Enter. That's what we are doing. Hope you got it how we are doing it, isn't it? So like it's a combined formula for one, isn't it? I told you in Excel you have functions and formulas. So if it has like sum, this one will be a function. While the plus, negative, plus, minus, the stroke or the division and multiplication, that one will be there. Those are the formulas, isn't it? So I think you will handle this one on your own because it's a very simple concept. I want to introduce something else. So just a minute. Okay, I've also sent the notes on common size financial statements. You will pass through them, isn't it? So just as a minute as I arrange here. So I think we look at common size financial statement or common size analysis of financial statement, isn't it? So this one is also a very, the file I've sent, someone is saying kindly resend the file, surely. And it's just above there. So common size financial analysis is a technique used to analyze financial statement by expressing each line item as a percentage of a base figure, isn't it? So like just a financial statement being expressed in a percentage form, isn't it? Very important in according to our next topic, which is forecasting financial statements, isn't it? This is the base from ratio analysis, financial analysis. So this is the base. So common size financial statement is also known as vertical analysis, isn't it? Vertical from up to down, common size. So it helps to compare the relative importance of different line items within the same financial statement and across different periods. So here is how you perform a common size analysis for the three main financial statements, which we have the balance sheet, the income statement, and the cash flow statement, isn't it? So like we start with common size income statement analysis. So to conduct a common size analysis on an income statement, each line item is expressed as a percentage of net sales or revenue, isn't it? This allows for comparison of relative significance of each expense or income item in relation to the total revenue, isn't it? For example, consider a simplified income statement below, isn't it? You can see with our revenue, cost of sale, gross profit, operating expenses, and net income, isn't it? So to convert this into a common size income statement, divide each line item by the net sales and multiply by 100 to express it as a percentage, isn't it? So we start with our revenue. So remember our revenue, so it would be revenue divided by revenue, isn't it? You get 100. Then cost of sale divided by revenue, you get 60. Gross profit divided by revenue, you get 40, isn't it? This 40 is the gross profit margin, isn't it? Operating expenses divided by revenue, you get 20%, then in net income. So this analysis shows that cost of goods sold represents 60% of revenue, gross profit is 40% of revenue, operating expenses are 20%, and net income 20% respectively of revenue, isn't it? And that is common size, also known as vertical analysis of financial statements, isn't it? So we check the balance sheet. So common size balance sheet or statement of financial position. Each item is expressed as a percentage of total assets, isn't it? It helps us to understand the composition of assets and liability. So we consider there we have cash, isn't it? Over total assets, isn't it? So everything is over total assets. So to perform a common size analysis on the balance sheet, divide each asset and liability item by total assets and multiply by 100, isn't it? So everything has total assets. You can see it's a very easy concept. Okay, thank you for clarification. Okay, we'll continue. So everything has, so we say statement of profit and loss or income statement, we divide everything as a percentage of sales. While the balance sheet or the statement of financial position, we divide everything as the total asset, isn't it? Presenting them as common size financial statement, isn't it? This one was in the intermediate level, the common size analysis of financial statement, isn't it? So this analysis shows that cash represents 16% of total assets, isn't it? That's what we've said. I think we won't repeat to others. It was just an example. Then we have the common size cash flow statement analysis, isn't it? For a common size analysis of the cash flow statement, Each cash flow item is expressed as a percentage of net cash provided by operating activities, isn't it? Everything over cash provided by operating activities, isn't it? To perform the common sense analysis, divide each cash flow item by the net cash from operating activities and multiply by 100, isn't it? The same thing. So we take our investing activities, divide by our operating activities times 100, isn't it? Or we just do percentage in Excel, isn't it? So because of the time essence, we just jump in straight directly. The same question that we've used there, but don't worry. So we have the income statement and the statement of financial position, isn't it? Required present the statement as common size statements or perform vertical analysis. I told you common size is also known as vertical analysis, isn't it? Vertical analysis of financial statement, isn't it? So you just copy the entries. This is also a very simple concept. It's more of the introductory part to forecasting financial statements, isn't it? So you just copy, then you also copy the years, Control C, Control V, isn't it? I widen the spacing here. Don't know it is small, isn't it? So we said under the statement of financial position, you divide everything as total assets, isn't it? So maybe I'll widen again the space here, put it there, isn't it? Everything as a percentage of total assets, isn't it? So cash and marketable securities. So here you must be very careful because we are looking something. So I'll take the cash here, isn't it? Divide by, I'll take the cash, divide by our total assets, isn't it? Divide everything as, be very careful here, check the log. So I don't want it to move to maybe to liabilities down here or to another value. So I'm going to lock 19, isn't it? And I will not lock C. So you lock with F4, press F4, then you press F4 again, isn't it? And you see that the dollar sign is in front of 19, isn't it? It means you've locked, so Control Enter, isn't it? And as a percentage, isn't it? Then you do 2 decimal places, isn't it? Percentages take 2 decimal places, isn't it? I drag up to there, then I drag up to there, isn't it? Then you must go into confirm. So you can confirm here F12, isn't it? Which is an other current assets. It has taken of divided by the total of 2018, the locking, isn't it? The locking. Any question about on lock? Because here is just more of locking, isn't it? You've seen the F4. Let me repeat the same thing here without locking, just to see the importance. Control C, Control V, isn't it? Look, in our question here, you can check from the formula bar here. It was C9 divided by C19, isn't it? If you just do directly, sorry, let me take the zoom up. If you do directly, it won't. So this one, divide by this one, isn't it? Then you do enter. Of course, the first one must be correct. But the second one will be correct also. Let me do, like the first year, it will be correct here if you do this. Be the same thing. But now if you drag down, you see it won't be the same. If you click in this cell, isn't it? You can see it is dividing short-term debt and other than current assets, isn't it? So if you were to drag, because you don't want to go one by one, it is vertical analysis, isn't it? If you were to drag, now, where was it? Where was that? I'll delete that one, or I'll just do Control Escape. Control Z, Control Z, 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 up to there, isn't it? You can see in this formula here. Let me click in it again, isn't it? I've taken C9, I've not locked it, so that when I drag, it goes to D10, isn't it? Escape, look here. It has gone to D9, sorry, it goes to D9, isn't it? Escape, it goes to E9, isn't it? If you don't lock. Then let's take off what I've locked. I've locked 19, isn't it? So 19 is this row here, 19. So I've locked this cell 19 alone, but I've not locked C. So that when I drag, it goes to D19, isn't it? When I drag, it goes to D9, but it remains on 19, isn't it? If you come here down, sorry, escape. If you come here down, it will be, it has moved down, but since the 19 is locked, it will not move further down, isn't it? Yes, we will use total assets. So we will just save that one here. Yeah, in common size balance sheet, each asset and liability item is expressed as a percentage of total assets, isn't it? Okay, I was saying, isn't it? As a percentage of total assets. That's why the C9 is on total assets, isn't it? We'll continue. So this one's a very small concept. It's like the introduction to forecasting, isn't it? If you understand the law key, actually there's nothing else will disturb you here in Excel, isn't it? Because when we go at least a little bit more further, there will be several types of locking, isn't it, of different types, isn't it? So you can just come on in this cell, you click Control C, you come here, you click Control V, isn't it? If I click in this cell, you'll see it has taken property, plant, and equipment divided by total assets. I told you formulas are given the higher priority than values, isn't it? I drag left, I drag down, isn't it? So for the total, you will not calculate the total, isn't it? The total will not calculate as a percentage, isn't it? So come to, again, I'll just copy, I come to, isn't it? You click in the cell to confirm. You can see it has now taken accounts payable divided by total assets, only the locking of C19, isn't it? Control enter. You drag left, you drag down, isn't it? And because there are three, and also here down, I can see there are three, I can copy the whole thing also. Then I do Control V. Isn't it? I click in to check. The first one is long-term debt over total assets. I press escape. I check non-current over this one, isn't it? I can see that it is correct, isn't it? Then I just copy one, Control C. I paste it here, Control V. I drag, isn't it? I drag down, isn't it? And that now will be a common size balance sheet. Simple topic, introduction. Like it's more of the introductory part to forecasting, isn't it? You must understand the common size. Isn't it as simple as that? This one is very, very simple, isn't it? So maybe like for forecasting, isn't it? You can be told, so like just like an example, you'll be told maybe there were 4 years, isn't it? They told you the marketable securities to sales for that year is expected, or for the period of the forecast, it's expected to be the 4-year cumulative average, isn't it? So for the forecast, what you use, for example, here you just do average. This one is just an example out of here. You do average price tab, isn't it, for the 4 years. So in forecasting, this is the percent you use, isn't it? Forecasting financial common size financial statements is just the percentage. The balance sheet is presented as over total assets, while the income statement is presented as of sales. Isn't it? Control C, Control V equal. Then remember it is sales divide by sales, and I'm locking. You lock with F4, isn't it? I'm locking 39 alone, isn't it? So that it can move to 2016, can move to 2015, because these one are the Ds, and here's the 39. I don't want it to move to 40 or to 41, so or even to 38. So it just remains at 39, isn't it? Enter. Obviously, the first year it will be 100%, isn't it? 2 decimal places, isn't it? I drag left up to there, isn't it? Then I drag down, isn't it? So obviously the gross profit margin, this will be the gross profit margin, isn't it? The balance there at the gross profit will be, what will be the gross profit margin? You see, it's like an add-on on the ratio analysis, isn't it? So we talked of gross profit margin, isn't it? This one will be the net income margin, isn't it? The same thing. So these one other expenses, so these one are like other expenses. Then the earnings, isn't it? Control bolt, isn't it? So maybe you are forecasting, you are told selling general and administrative expenses are modeled as the 3-year cumulative average, isn't it? You'll take so for the 3 years and find the average that you'll use in the forecasting. But generally, the thing is, common sense financial statement is presenting the statement as a percentage, isn't it? For the income statement, it will be over sales, while the balance sheet will be over total assets, while the cash flow statement, it will be over operating cash flows from operating activities, isn't it? And it's just that way. So, but for common size cash flow statement, you just take the 3, that is the operating activities divided by operating activities, which would be 100. Then investing activities divided by operating activities, then financing activities. So the total, isn't it? I have explained on why I locked 19, isn't it? So like the recording is always sent by the management, isn't it? That one I talked of it. Yes, and I think the point is home, isn't it? Or is there any question on cash flow statements, common size statements? Because when we come, I want to do trend analysis, we do cross-sectional and use of graphs, then we start on forecasting, isn't it? Where it has never missed forecasting for the previous papers, including the pilot paper, isn't it? They become 3. Forecasting has never missed. So like, I think the class today will end there. Point to take home. Let me just see the text. Repeat the locking process. And I'll just say that this locking process is very, very important, isn't it? It's very important even for forecasting. Without knowing how to lock, actually you can't, isn't it? Let's not use this example. Let's use another example here. I think it will be more understood, isn't it? I'll use just a common one. You see this way so that you can understand, isn't it? Then here we have some value like 20, isn't it? Here maybe say 30, tab here we say 40, isn't it? So we are on just locking, isn't it? So, for example, I take this value, isn't sorry, just let me make the data in a way that it can it can fit all the three, isn't it? So we have, like, it's called self-referencing, isn't it? Actually, it's not called locking. The appropriate word is called self-referencing, isn't it? So self-referencing in Excel, we have three types of self-referencing, isn't it? We have absolute self-referencing, we have relative self-referencing, and we have mixed self-referencing, isn't it? So we'll start with absolute self-referencing. So absolute, it means you fully lock it, isn't it? Equal, we say we take this value, isn't it? You press F4 once. You can see that the dollar sign is in front of P and it's also in front of 8, isn't it? It means it has been fully locked, isn't it? You multiply by this value here, isn't it? That one I'm not locking it, isn't it? Then I do enter, isn't it? It's just 20 times 1. Then if I drag up to there, isn't it? So it will remain here. If you are clicking this cell, it will remain 20 because 20 was fully locked. Absolute referencing, isn't it? Because it was fully locked, isn't it? Again, okay, I press escape. Sorry for that. Then let's do another type of, isn't it? So I take the 20. I'm not locking it. I do multiply by. Because for the first example, we locked this one. I prefer we lock it first. Again, fully locked, isn't it? Then I'm taking the one here, isn't it? Here one, I want to lock one part, isn't it? So I'll start with locking P alone first. We do that one. So you press F4, you press F4 again, you press F4 again, isn't it? Control, enter, isn't it? So if I drag along, it will remain 20. Because why? You come here. Our 20 here was fully locked. It means it doesn't move. While our P here was fully locked, P was locked, 6 was not locked. So it means it doesn't go to Q. It remains P, isn't it? Escape, you check here. It remains to P because P is locked. It doesn't go to Q or R, isn't it? Then the same thing, the way we've locked, I drag down, isn't it? You click in the cell, you'll see 20 is fully locked. It doesn't move if you fully lock it. This one is called mixed cell referencing, isn't it? I've just locked P, isn't it? So I've locked P, but I've not locked 6, isn't it? I've not locked 6. So it will go down to 7. That's why if you click here, you can see it is P7, isn't it? Escape. Then now the other one that is called the relative referencing, isn't it? I take the 20. So relative referencing, there is no locking, isn't it? Times the 2, isn't it? If I drag, maybe I reach 40, isn't it? Because if I go here, it becomes 0. So this one I've not locked. You can see that it was this P8 and P6, isn't it? I press escape. If I log in here, it is R8 and R6. So it moves that way, relative cell referencing, isn't it? So for the balance sheet, we don't have to use the totals. Like, it's not really a must. Like, you can do also the totals. It's the same thing. It's just the same thing. So let me confirm the chart. I will think. Yes, there's someone who has given a good explanation. Let me see him. Let me see Zach. So Zach says, locking is dependent on the row or column, isn't it? So if you want to lock a cell with moving, you use the dollar sign in front of the cell, It can be a number or letter, isn't it? Remember, if it's a letter, it's columns, isn't it? And if it's a number, it's the rows, isn't it? So if you want to lock a particular number in a certain row, you lock the number. But if you want to lock a particular cell in a particular column, you lock the letters, isn't it? Yes, it is just that way. So practice on that, on cell reference. Sorry, we are experiencing some internet issues, but the thing is that you practice on the locking, isn't it? When we come back, we do on the follow. We'll do on trend analysis, and then you complete the common size that has remained, isn't it? Because it's just vertical analysis over sales, and the other one over total assets, isn't it? When we come back, we do trend analysis, we do cross-sectional analysis, we go use of graphs, then we start on forecasting financial statements, then we start on sensitivity. You see, so HP everyone. Okay, I think the class will end there for today.